So today I want to be covering this very interesting topic because it's my belief that economic growth for the continent is going to be engineered by a lot of tech startups. And already we've seen a lot of funding coming into the continent, and it definitely, of course, there's a winter now, but it's not going to stop it, What it's just going to do is produce a different breed of founders that are going to build great products that not just rely on venture funds, but they are sustainable on their own. So a little bit about myself, I'm a partner at Startup Launchcode. We are a growth studio for early stage companies. We kind of help startups with their go-to, market strategy, traction, and everything else. So that kind of summarizes what we do. I don't want to get too granular about it, but it's a lot of work because in terms of building, showcasing that what you have is, built to last. So an investor requires a lot of work. By the time I get you to seed, Series A, you already have some things going on for you, except something really bad happens that takes you out of the game, but you're good. So this is the stage we play in currently. So to continue, topic is, what we'll be covering today is basically where ideas come from, how to assess the viability of an idea, what factors contribute to startup success, and so much more. So I'm going to start with a question, right? I'll start with a question which I'll throw to the house, not too many. Where do great ideas come from? I need volunteers. Where do great ideas come from? Anybody? Anybody? Where do great ideas come from? Sorry? Yeah, okay, that's a good one. Who else? Anybody else? Inconvenience. Got it. So what he said is actually true. Great ideas come from opportunity and problems. So if you look at all these different great companies that we all know, Airbnb, Amazon, if you look into what they're doing and where they're coming from, you always see that same thing. It's either an opportunity or a problem. And this is going to be the norm of anybody trying to do something in the tech space. You're going to see an opportunity. And the thing is that opportunities are sometimes have very small window. So if you don't act, sometimes, it just disappears. Or there's a problem that is really pressing. It could be personal, or it could be something you just observe. So these are a number of things to take note of. So I'm going to talk about what these companies all have in common, which I guess we all have an idea. Number one, they all have a valuation of about $1 billion. One. Two, they're addressing a unique problem or an opportunity. Three, they're operating in high growth markets. Four, they are always ahead of the curve. And five, they are all leveraging blue ocean strategy. I'll focus primarily on the fifth one because this is the secret to actually how successful a startup can be, especially in the early stage. And the others, really, if you get this right at the beginning stage, it's easy to get the rest, as you go on. So I'll talk a bit about what blue ocean strategy and why it's very important for you as a founder to think from that, standpoint. So blue ocean strategy basically is the pursuit of differentiation and low cost to open up a new market space or to create a new demand. I'll still break it down. So everybody starts out in a particular industry, right? You hear, oh, there's money in the fintech space. So someone just creates a fintech app just for transfer. But there's so many players in the space that are probably bigger than you. So you're entering the same space that is already crowded and you have to compete. That's why when you meet some investors and tell them about, oh, I have this great idea, fintech, and okay, we'll get back to you, let's see how it goes. They know that you need to have a very unique idea to really give yourself an edge. If you don't have that, they're not going to put money into that. So what they look for are, businesses that have something different, are also disrupting existing markets. So more of that as we go on. Blue ocean is the way to go, where you create an edge for yourself. You give yourself that runway that allows you to capitalize on that marketplace before anybody jumps in. Because give or take, every given market, if there's demand in that market, right, you're not going to be the only player in that space. Someone is going to come behind you soon enough. Probably someone that has more money. So if you look at a company like Opay. Opay wasn't the first in the bike railing business. Go-Karter was the first. Then Max. Opay just raised more money and just crushed all of them and became the market leader, and they are now a unicorn. So if you see an opportunity in this space, expect that someone's going to come behind you. Expect it. So Blue Ocean, gives you a different way of thinking of how you can execute, keeping in mind that there needs to be demand. You are not just going to start something that nobody's really going to, buy or engage with you. And that's why you hear the people talking about emerging markets. Emerging markets are the first players in that space to really, blaze the trail, and the market now picks up. So all along with that, so Red Ocean, basically, you're competing in an existing market. And Blue Ocean is basically new market creation. I'll explain more of this as we go on. So Red Ocean just focused on trying to beat the competition. So you enter a space, the next thing is that you're thinking, I'll reduce my pricing just to give me an edge, which is the cheapest strategy. It doesn't take any great thinking to lower your prices. It's the easiest thing to do, While, Blue Ocean is about making the competition irrelevant. Red Ocean basically captured more of existing demand. Blue Ocean basically is creating new demand. And Red Ocean making value cost trade-off, while Blue Ocean is disproof of the value cost trade-off. I'll explain this as we go on with real examples. So all it means is that, if you want to summarize it, Red Ocean is basically trying to just be a Me Too product in a space that there are already players. And if you look at across all the industries that probably you are trying to build something for, you want to ensure that, are you really just a Me Too product, or is it a product that is really unique? Because if you're a Me Too product, then you're going to struggle. You're going to struggle from the get-go. So it has to be something really unique that, in a way, is disruptive in itself. That's why if you look at many of the unicorns, look at, let's say, a company like Paystack, Flutterwave, they were just ahead of the curve. When Flutterwave started in 2016, there were banks. They just came to disrupt the banking industry. And of course, we know he left Access Bank. So with that knowledge, he knew the problems that already exist in the marketplace. So you want to start with things that are different from what is already there. So every single company I'm going to just dive into, all leverage that. We all know their business with Amazon. Everybody talks about Amazon, but if you go back to the beginning of Amazon's story, Jeff was he had a very good job as a hedge fund manager. And at that point in time, he saw that his job was to research the internet, and he saw the internet was growing at the 2,000% rate. And he thought that this is a huge market to capitalize on. And he wasn't even thinking of anything extraordinary. All he just said was, you know what, I'm going to just sell books online. Mind you, he wasn't the first person selling books online. As at the time Amazon started, there was Barnes & Noble. Barnes & Noble started in long before Amazon. And that same year Amazon was starting, Barnes & Noble they had $1 billion revenue. It's not like they were nobody. They were selling books. Amazon just took the same concept and brought it online. And they've expanded. Right now, Barnes & Noble are, they're not even anywhere close to Amazon. So all I'm saying is Blue Ocean strategy. Because if he's still trying to engage the same customers, but he's bringing a new platform in which they can engage with him, right? So, like I said, Barnes & Noble was just 1873. Amazon was just 1994, right? At that point, they had 500 bookstores, long before even Amazon, was existing. So, what I'm just trying to show you is what Blue Ocean really means. And I'm going to, during the course of this, I'm going to just use real life examples, just so you see all these things I'm saying, not just, you see that this is what makes some companies great and just some companies fall behind. Simple. Now, if you look at Amazon, right from 1997 up until now, this growth, as a matter of fact, was even it really began to take off as at the point they introduced Amazon Prime. Like in 2005, thereabout. That's when the climb started to happen. Before then, Amazon was operating in loss for years. But they had to believe that they're onto something big, and it paid off. So all I'm trying to say in essence is that you want to observe the markets, read the markets. And that was because that research of if this internet is really growing, you don't even have to have a very fantastic idea. You just have to position a very even average idea, and you will go well. That's the way to also look at it. What trends are you going to leverage to actually drive growth for the business? And for all points in the time, Amazon understood the game that they were playing in. They realized by ushering in Prime, it would change the game for them. And obviously, from 2005, they realized that the non-Prime, Amazon Prime customers spend about 4 times a non-Prime customer. This was what they used to build the first layer of their ecosystem. Everything else came on top of that. AWS, Amazon Video and all of that. But it's still the ecosystem. So you want to always think ecosystem while you are building. Because why? There's someone is going to come to try to steal your customers. So on with that. Second is Tesla too. Tesla, everybody knows Tesla now with Elon Musk, but Elon Musk didn't really start the company. He just brought his money into it after, selling off PayPal. So as at that point in time, what were they trying to build? Electric vehicles. It was still a struggle. So this is the automobile market that already exists with players like Toyota and the rest of it that are mastered manufacturing. Tesla just came with something different, electric vehicles. Then it was not even a thing to consider because there needed to be a lot of infrastructure. Tesla just made their first profit in 2019 or so, from when they started in 2002. But what they were doing, and like what I'm saying now, it's all about positioning. If they wanted to just be a regular car that has fuel, they won't be in the space. Other companies would have crushed them. So the same thing we see here with these businesses is, number one, they position themselves in an emerging market. And when the market began to grow, they just became very successful. So it's also a risk too, because you have to be onto something really big for you to operate at a loss for a very long time. Like I'm talking about Tesla. Now, Tesla has raised about funding of $20 billion. Who will give you money? They have to give you money because you have an advantage in that space. Nobody gives money to a gamble. You have to have concrete data, and that's what Amazon said. If you check Time magazine in 2000, they were saying, Jeff, this thing you've been running for a while. There's no profit. Is that a problem? But Jeff Bezos was like, they've seen the trajectory of the business. They know it's going to be profitable soon, and they did it. The same with Elon Musk and the rest of them. So it brings a whole new way of thinking about what ideas do you need to start and how do you position it before you even, come up with like a pitch deck or even build a product. The trends are very important to the success of that because you are in a marathon, not a sprint, right? You might get to, and also maybe not for this, but you also are thinking exit before you even enter. What if someone buys you up? All this kind of thinking goes into what ideas you want to create and who are the players that you could engage. Like if you look at a company like Paystack, who funded Paystack seed round? It was Stripe. So it's not surprising that Stripe bought them out. So you want to also look at all those things in terms of coming up with an idea and how to go about it. So let me move on. And these are all the other players we all know these brands long before Tesla. These are really good brands. So for Tesla to come in this space, you have to have something that is just different. Look at the valuation of Tesla right now compared to all these other marketplace, players. Tesla currently about 1.2, about billions, all these other players combined. So I'm just trying to lay a business case for how to position and how to look at, what you are building and make sure that you are thinking blue ocean strategy from the get-go. So let me just skip that. Same thing with Netflix. And I'm using these companies because 9 out of 10 times you'll find out that whatever it is that you're going to build, there is already someone in that space, right, that is there. I'm using these known people for a particular reason, for the simple reason that they all had bigger players than they in that same market they were going from. What they had was they understood the trends and they had blue ocean. Amazon just coming with online bookstore, starting out with that. Tesla coming with electric vehicles in the automobile industry. You check the same thing with Airbnb, just coming with hotels, not really like the regular Marriott and the rest of them. It's all disruptive way of thinking about a space. Because for you to build, basic economics says demand and supply must exist for the market to even be there in the first place. So you want to understand like what market are you, understand really the market dynamics. Because if you don't have demand and you go building, you might run out of cash. You need to establish that there are people that would want what you are selling before you even start even thinking of creating something for them. So they say Blockbuster was a big deal then when Netflix started. That was in 1985. Blockbuster had $5 billion in revenue when Netflix was even still like trying to even start out with 8,000 stores. And if you look at it here, Blockbuster started in 1985. By 1994, they had a valuation of about $8.4 billion. Netflix was just founded in 1997. To say you are streaming movies online was not even something to consider because Blockbuster actually thought about it. But you're like, it doesn't make sense to our revenue right now. If you read this guy's work, Clayton Christensen, The Innovator's Dilemma, he spoke a lot about these things. So these are what is called like emerging markets, emerging technologies that just, the big players just don't see the need to go there because it doesn't just fit their revenue, the kind of revenue projection, so to speak. So as at the time Netflix is touting video streaming, Blockbuster is like, it's not something we want to consider. But that was the internet growing at a rapid pace. So you see what I'm saying, that even a regular idea in front of you, just a very good trend, can just transform your game. Because all Netflix did is, they took the same thing Blockbuster was doing, movies, and just brought it online, ahead of the curve. And sometimes you think about it like, but these other companies, didn't they think that they should pivot to there? But you realize that when you build a business in a certain way, it's the same thing with, if we look at ChatGPT and Google. It's literally disrupting Google's model at the core. So this is actually the trend of how sometimes like big empires even just crumble all of a sudden. Not that I'm saying Google is going to crumble, Google is trying to respond, but these are the things that lead to that. And technology just comes on the scene that is ahead of the curve, that people just ride it, and all of a sudden they are, what we expect them to be today. So, like I said, every market, there will always be players. Disney has launched theirs, HBO, everybody's going for that. So even Amazon as well is going for that. But Netflix still owns like a major share in that space. Why? Because it just had that leverage. And if you look at it from 1994, that's what I'm saying, like building great things takes a lot of time. From 1994 to now, imagine how long they've been at this game. So it requires a bit of like resilience on the founder's part, what you believe in. I always say like, if you think back when Facebook was starting out and, Yahoo offered Facebook like $1 billion, and Mark is like, no, it's ridiculous. You have to know what you're building to say no to those kind of offers, So on and on, Netflix has just showing like the revenue growth of these businesses and just to establish the need for blue ocean strategy thinking in terms of like building your ideas. Now, coming down to how do we assess ideas, basically. So I've laid a case for red ocean and blue ocean strategy. Like, first thing you need to ask yourself is, are you really going to head on the other big, I'll use the fintech space for instance. We all know the fintech has received the most funding in Africa right now when it comes to, investors, VC funds. So the question is, if you're building anything fintech related, is it blue ocean? Is there someone else already playing in that space, or are there people that are playing already in that space that you are probably going to either be a me too, or are you thinking about how do I bring a twist to this thing and ultimately disrupt that space? Disruption is the order of the day, really, in many of these things, to give the business an edge. So venture capitalists are not evil people, but they understand what it takes to actually win. So give or take, if you look at it this way, if you had to invest across a number of companies, you're looking for outlier. So like Warren Buffett said, he and his partner, they could sit on billions of dollars and not invest in anything, just waiting for a good deal. Because you're not thinking in terms of like today, tomorrow. You're thinking 10 years investment that you can reap from. So if you are trying to get an investor, they are looking, because they have to get this money from family offices and even pension funds. And the hope is that we can invest in a business that if you give it 10 years, it will reap back. So, and when you look at the case of like Flutterwave started 2016. Right now, they're thinking of IPO. If they hit IPO, GB becomes like a billionaire just from that alone. And so think of the first players that invested in Flutterwave. That is cashing out. You're cashing out in like 6 years. It's a good deal. Think of like company like Paystack, where the Paystacks at almost the same time Flutterwave too. They sold out like 2020, they're about 200 million. People that invested in it, they've cashed out already. So investors are thinking year and year on return. How do I recoup back my investment? So for you so if you took like a 1 million from a family office, or you took like a 1 million from pension fund, you're thinking, how do I give back? How do I get 3 million from this and return that money? So you are looking for businesses that can generate that kind of volume. So in that case, you can sit on money, just management fund, and not rush to invest in anything because you know what you're looking for. If you rush and invest in it, you stand the risk of losing out. And across the board, whenever they invest in companies, they're looking for 3-4 different companies that can pay off that investment across. Some will work, some won't work. So as a founder, you have to think from that way. And that's why they can read. If you meet if an investor that is particularly into fintech, they know what they're looking for in the fintech space. They're looking for things that are just different. Nobody else is doing it, because that is the only way they can guarantee, with a little support, they can actually achieve the returns that they're looking out for. So there are 4 things we actually use to assess like a market, which everybody knows: market size, the market dynamics, the early adopters, and the value proposition. So market size, everybody knows this because we all put it on our pitch decks. TAM, SAM, SOM, everybody talks this market, $1 billion, everybody's talking billions, And then the serviceable addressable markets. Then within that is the early adopters, because early adopters is what guarantees who wins and who doesn't. Every single company starting out, like when they started running the analysis of the different companies that have hit like 1 million users, and they said ChatGPT did it like in 5 days or so. That's like record. Nobody's ever done that before. What is it? Early adopters. That's all they're looking for. You're not looking for mainstream. You're just looking for people that are going to use the product as early as possible to help you like a proof of concept that this is something that went on to something big. And even in the video, just to come back, the video that when we were talking with Sam Altman in 2019, and I asked him like, so this thing you're building, what is the possibility of revenue stream? I was like, okay, when we build it, we'll ask the AI, how do we generate revenue? And everybody was laughing. And I said, no, you can laugh, but that's the truth, But this is a business not generated revenue. And Microsoft is coming to say, you know what, we'll give you $10 billion for about 40-something% stake in that business. Because they understand the game of, if we get this, we already know what they are doing with it with Bing and all their products. It's a game changer because it's all about market leadership. Everybody is looking for something that can give them that edge. Like Google is even feeling threatened and coming back. So this I'm just using these ideas in terms of like just to sensitize your minds in terms of like how to look at what you're building, from scratch. And possibly you can visit the drawing board and really like take time to look into your products and really give it like a good runway by thinking these things through. So the Boston Consulting Group actually called like defined they created this back in the days called the BCG matrix, where they like the star represents the businesses that are in high growth markets. So this shows the market growth rates, and this also shows the market share. So when you say your let's say for instance your TAM, total addressable market, is about $10 billion and growing at whatever rate. That's it. And you've established that it's a high growth market. The question now is, how much of that market share can you get within a particular period in time? That's a whole new way of thinking. There is it's growing, but how much can you get? Because if you're in a fast growing market, and like I showed you of like Netflix and Tesla and the rest of it, if you're in a market that is growing at, let's say, let me use 100 billion. If your market share is even 1% or 10%, you're very profitable. So it has to be a market that is rapidly growing. Then your strategy has to now be, how can you get much market share in that space as quickly as possible? So, and this is how also investors look at it. That's why if you most of the things that you probably be feeling, they ask about the market size. The investor will ask you, what is the market size? They understand that. And by the time they're really getting into talking with you, they want to know how much market share can you really get in that space, which now comes to like the team players. What is their thinking? What is their background? Because before you even build a product, there is founder market fit. You need to understand the market. You can't jump. You can't actually, let me say, you can't circumvent the fact that you have to execute to get enough market share for you to be profitable enough. So high growth market, in other words, what I'm trying to say is that this is the place to be in if you're starting any idea. It must be a star business. It must be a fast growing market, and you must have enough market share there. ChatGPT, that's what they're doing. Emerging markets, fast growth. Tesla, every single of these unicorns that you see are all star businesses. So, and if you look at even businesses, by the time they begin to flesh out, they have different products in these different places. Google search is Google's cash cow. So that means that is a business that basically, let me go back. That is a business that, number one, they have a high, it's also like a high growth rate, but let me put it this way. They have a high market share in it, but it's not a fast growing market. Because it takes a lot to build a search engine. It's not just like something you can wake up and do. So in looking at your business, you need to know what are the cash cow, what generates the money for you, and what positions you to actually benefit from the near future. So this is another framework we actually use in looking, and even investors use it. That market must be growing really fast, and you must have a plan to get a lot of that market share. Second is market dynamics. So this is Porter's forces. And Porter's forces takes into consideration all the other things within that market. So we all know, like in Nigeria, you want to start something fintech related. The government is an issue. Regulations is a challenge from the get-go. That is a threat to your business. Threat of new entrants. What is the cost to actually enter that market? Because if it's low, if there is low barrier to entry, you're going to have a challenge because everybody can come in and compete with you. So you have to consider all these things, the threat of substitutes. So you are an app for transfer of money from here to there. What are the other options within that space that are doing the same thing as you? That's a threat to the business. The bargaining power of the buyers, meaning that the buyers can say, you say this is your price. The buyer says, no, we want to buy it at this price. So these are factors to consider. So if you even look at, let me say, a company like Apple, Apple makes the most of their products from China. Many of these factories too also do with Redmi and the rest of these companies, but Apple commands premium prices on their products that Redmi and the rest can't do. But they are also very quality products too. So these are the things that you look at to demand the supplier. So for every single, like now they found lithium in Nigeria, and a big deal is like Tesla needs some of these things for their EV vehicles. So it's a good deal. So for companies like Apple that need this large-scale manufacturing, they begin to invest in companies that have access to the raw materials that they need. So that's where it comes to the bargaining power of the supplier. You must have, Apple has many of the shares in the things they need, those chip companies that are producing for them, they have shares to control, to ensure that their business still stays afloat, and not that someone can decide tomorrow, I'm not selling to you anymore, and they don't have a business anymore. So these are the things you have to look at, the threat of the bargaining power of the suppliers, new entrants. So let me use the Tesla example. that is a market that you can't just enter into that space. It's highly capital intensive. That in itself help prevent new players from entering that space. It's only established businesses that can threaten Tesla. So in your business, is it easy for anybody to wake up tomorrow and have an app like yours? That is a problem, because that will also affect your market share. And how many substitutes are in that space in terms of like, with people, if something goes wrong with your app, is it easy for someone to just jump to the next one, out there? So these are all the Porter's forces. You can even Google it and read more on it. Very critical in defining like the market dynamic, because like I said before, for any given market, there's demand and supply. So who is supplying and what is the demand like? So if you are the supplier, in terms of like you have a product that you are giving to meet that demand, you also have to think that who are the other players in that space and what are they doing and how do you make yourself relevant for a very long time. So I've taught this a bit of like the ChatGPT and Google clash, which is basically a typical example that no matter how fantastic you are, someone is going to wake up tomorrow and challenge your spot as a business. So since 2019, when the Google founders left, they had to request for the code because they've always had AI. They've always had AI behind the scenes. But the thing is like, is the market ripe for this? But as ChatGPT is leading that charge, they have to respond, because if Google is knocked out of that position, the search engine, which powers their ad network, which 90% of their revenue comes from, Google is crashing straight up. So the way this tech space is, nobody is scared of you. If you are sitting on a pile of money, someone is willing to disrupt you. Just like the way Elon Musk can think of disrupting BMW and these other brands that have been there. Just like Airbnb also disrupting the Marriott, Hiltons, and have been there for a very long time. Uber, the same thing. So you have to have a response strategy, because somebody is thinking of how they can remove you from that position you are in. So it's not like once you start it, it's going to stay like that for a very long time. It's a very dynamic space. Next is the early adopters. So in any given market, we are rolling out a product. They are the innovators, but the most important people to get are the early adopters. Early adopters are people that are willing to actually try your product and use it. And that gives you, this is basically the adoption cycle of any technology product. And being in the tech space, every single person, every single founder, we want to have clarity on who our early adopters are. Every single business thinks early adopters in terms of like coming down to the persona. Who is the target market? What are their needs? The way we put it is, who is my customer? What do they want? Why do they want it? And how do I get it to them? Now, ideas enough. Very important question. So this is Bill Gross, so the CEO of Idea Lab. So Idea Lab is basically create companies, more like a venture to create companies and turn down. So since 1996, they created about 150 plus companies with 45 IPOs and acquisitions. Coinbase actually was from there. So Bill Gross says about from all the companies, success and failures that they've had, there are 5 things that really stand out and make a startup successful. And he says 1 is the idea, 2 is the funding, 3 the business model, 4 the team, and 5 is timing. Now, every founder really controls the first 4, but the 5th is out of your control. You just have to observe, just like I mentioned of Amazon and the rest of them. So let's talk about the idea. So we all know Uber IPO and everything. So their whole journey started like back in 2008 thereabouts, when they were both in Paris and they could not find a taxi in December. And that was how the idea of Uber was born. It was a very new idea. Like it took a while for even like investors to hop in on it, because it just seemed, why would somebody use their house to pick another person? It just didn't make sense at that point in time. So I'll still come back to that. Funding, since Uber started, I think till now, Uber is still running at a loss. From I think 2019, we were about $65 billion in rides, about 14 billion in revenue, and they had a loss of about 9 billion or so. So they've been running at a loss. But in terms of like, are people using it? Yeah. So there's still it's weird in the tech space that you can run a business at a loss for a very long time. So that's Uber for you. The business model, simple. Connecting riders and drivers together. But what is really interesting, because if you think back to when Uber really started, they had to engineer this process. Now that people are, it's a thing that you can just like, go on Uber and use your vehicle and stuff like that. But then they had to basically get about few cars to engineer it, because it's not like, if you think of it in a space like New York, that's a rough area, someone can enter your car and just kill you for nothing. So they had to deal with those real life issues. The same thing with Airbnb. But the business model was very unique, was very different, unlike anything anybody else has seen. In other words, people didn't even give it a chance. Like this will work, or like Airbnb, like that will work. But the business model made a lot of sense. At least not at that point in time, but they actually, made it evolved it. Now, the team, Gary Camp actually came up with the idea. Travis was one of the first people to put his money down. Now, this guy in the middle, at IPO, this was what they cashed out of the Uber deal when he went IPO. Gary made 4.1, Kalanick made 5.4. Then this guy, Ryan Graves, when he had the idea and he came back, Travis had written on Twitter that they're looking for a product manager, and he responded he could do it just from the tweet. And he came in as an intern, and eventually he became the CEO of the company, then dropped down. So just for being on he was the first employee in Uber. He was able to get 1.5 million just from that alone. Wow. So this was the team that actually started this whole, Uber business and all of that. I'll skip this. So now talking about timing, like I said, it's almost out of every founder's control. Now, what really happened, if you remember the 2008 recession that hit the US and most of those countries, we found out a lot of people lost their jobs, homes were lost, and so that gave relevance to businesses like Uber and Airbnb, because people were now looking for other ways to make money. And keyed into their model, I have my car, I don't have a job, come on Uber. And that was really what made Uber successful. If the recession didn't happen, Uber may not have achieved the success that it got. So timing is very critical, and it's sometimes out of your control. But you can observe trends, like I mentioned of Jeff Bezos saying that trend is internet is going at 2,000%. Just position yourself in front of a trend, and the wave comes and hits you, and you'll find other business that. So, and that's why I say some opportunities have a small window. Because if Uber had waited long enough to, we'll just chill and wait the recession comes down and we start, they would have lost that opportunity. They won't be where they are today. So these are the 5 things that really makes startup successful. And at the top of all of them, Bill Gross says timing is one of the most essential factors for startup success. So the idea is that you have that they're just a particular small window that you really need to take to really launch it. If you miss the opportunity, just forget it. Move on to something else. So they rated it and said timing is important. The next is actually the team and execution. Because you find out with the game of startup, what some things you start out with don't eventually turn out to be what you think it to be. So with a dynamic team, you can pivot to something else and still stay in the game to figure or get product market fit. And the rest is the idea itself, because if it's an idea, anybody can come up with an idea. I'm very sure that if you think about it, we'll see 3 or 4 people that have some similar idea. When you see someone launching that, I had the ideas, so idea is a damn it doesn't, you get. So I think that kind of wraps things up. So at this point in time, we will take questions and then Steve move on to time.